Hello, Mark Ostfeld from ADM Investor Services International. As we come sort of into the second, third week of the US corporate earnings season, it did seem to me that it would be appropriate this week to have another look at what's been happening with credit spreads, and above all in the context of what's happening with equities and earnings. Quite a lot of familiar charts on this week's video. The first one, always a good place to start, is the contrast between investment grade spreads and high yield spreads. On the chart, the white one is the investment grade, high yield is in yellow. Really, all one needs to do in terms of looking at this is look to the left to see that, yes, we've had a terrific amount of disruption around the end of March and through April and through much of the second quarter. But we are now back at levels, both in terms of high yield spreads and in terms of investment grade spreads that prevail for much of 2019. So everything is perfectly normal according to credit spreads. Does that look any different in Europe? Well, the answer to that very simply is no. We've got exactly the same sort of story. In fact, for choice, investment grade spreads are amongst their tightest levels, not quite at pre-crisis levels, but not very far off. To some extent, one can say that's not really surprising. We've had all the ECB stimulus, the promise that they're not going to withdraw any of it anytime soon, and they might do a great package finally delivered by the EU 27 governments, which should definitely give some support to the post-pandemic recovery, even if it's going to be a slow recovery. So it's not really surprising that these are at such tight levels. But nevertheless, if one then sort of says, well, what's the picture look like in terms of Asia? Because obviously Asia, to my way of thinking, is probably still one of the key growth areas. Interestingly, the spreads in terms of Asian high yield debt denominated in US dollars, which is my third chart, aren't quite into the levels that they were before, which reflects a lot of currency weakness that we've seen in quite a lot of Asian currencies and concerns about how the US China tensions play out in terms of this, in terms of global demand. More broadly, in terms of emerging markets, obviously, we've seen, which is on my fourth chart, basically much the same sort of picture as with dollar and euro denominated investment grade and high yield debt. Spreads tightening quite considerably back to the sort of levels 2019. Again, here, one would have to add the big caveat on this is obviously they are being kept wider. One, because of the problems that are there in Argentina. Two, because of in broader Latin American terms, the enormous risks associated with the spectacular levels of infection rates in Latin America, which imply obviously the recovery there will take quite some time. What does this mean in terms, we've got all people buying all this credit, all these corporate bonds from some of the riskiest companies. Is it telling us anything different to what the S&P 500 is telling us? Well, no. My final chart is the change in forward 12-month EPS estimates for the S&P 500 against the index price. The index price on this is the turquoise line, and the EPS line is the bottom one, which has obviously deteriorated very sharply. Some might say, well, it's turning up now, but let's have a look, when one considers where we've come from and the fact that we are at the highs, I still think this sends a message about central bank financial repression and why people are chasing credit and indeed equity indices. At some point, when we start getting a lot more defaults, when we start seeing a lot more layoffs, as appears to be the case, there is going to be something of a reality check, in my opinion, for financial markets, even if central banks provide this huge backstop that they've been providing. And those are the thoughts for this week.